Good afternoon, folks. It's Dave Burrows. I'm CIO and CEO here at Barometer Capital Management. I want to thank everybody for jumping on today. A little bit of volatility over the course of the week. We had a few calls this morning and a couple of calls on Friday. Folks interested in talking about what's going on. A little bit of saber rattling going on from both sides of the ocean. Some coming from China, some coming from Trump. And on a liquid Friday, certainly a little of excitement in the market. As always, we have folks jumping on here who just want a quick review as to what we're up to. We have others that are on every week and have lots of questions, and we really appreciate all of you for jumping on. As usual, what I want to do is take a bird's eye view of multiple asset classes to see what's changing, what isn't. I'll talk a little bit about what we're watching, things we're thinking about. And as always, we try to be transparent and give a very clear idea of what it is that we're doing in the portfolios, because at the end of the day, our job is to recognize change and adjust the portfolios accordingly. And it doesn't tend to be wide sweeping adjustments. There are obviously some times where we're moving faster than others. But it's a series of iterations to make sure that we kind of stay in touch with what's actually happening in the market. So the S&P has been in a structural bull market since 2013 when we exceeded the highs from 2000. And that has continued sort of unabated with interruptions. Certainly, when we talk about the calendar, September is a month that we care about. We're through September. We talked about how the first 2 weeks of October tend to be the weakest 2 weeks of the year. We're basically through the first 2 weeks. If the market were to follow seasonality, October winds up positive, which it is right now. November and December tend to be stronger months. Now, of course, every year is different. The underlying conditions are different. So we're always looking to see other things that don't stack up based on what we're seeing going on. But the market's had a decent year so far. There have been some very clear pockets of strength and obvious pockets of weakness. Although in general, the weak pockets have been the most defensive parts of the market, the parts that investors might go to hide if they thought there were, significant concerns. But when we look at the S&P, when we look at the S&P 500, it's been in a channel really since May. We saw the April lows after the initial round of tariffs rally back above the long-term moving averages. We've been kind of marching higher. You can see this red bar from Friday. That was a significant shot down, basically to just above the 50-day moving average. Market bounced yesterday in the U.S. while the Canadian markets were closed, and then a little bit more today. So trying to get back up into that channel, something we're certainly watching. We watched the QQQ, which is the Nasdaq 100. This has been leadership in the market over the last several years. And that also, has had a nice march higher since spring, staying in this sort of broadly defined channel. And that's one way of looking at things. But this, again, was a very big down candle or down day on Friday. And so there's different ways to look at this. Others have looked at the QQQ in the form of a rising wedge from a technical perspective. And if that were the case, Friday would be a more concerning look, because certainly we broke down out of the uptrend we've been in place since the bottom in April. Now, market bounced yesterday and tried to bounce today, actually probably closed a little lower than what's showing here on the chart. So that's something for us to keep an eye on. I think most folks know that as a firm, we have had a reduced exposure to the Nasdaq 100 and tech in general. We've had some of the tech leaders, but our position size has come down fairly significantly. In fact, last week, James and I had a great chat about some of the positions we've recently exited in the Nasdaq in favor of some more global positions, in favor of some more industrial positions. So we'll look at that lens as we go along. On the Russell 2000, small caps, there's a 5-year chart. And I do think it's interesting that the Russell 2000, well, the Nasdaq, has had a couple of days not going too far. The Russell actually had an excellent day today. And this breaks it out and closes above the high from back here in 2021. So again, something to watch. It's not definitive. The breadth data within the Russell 2000 is still a little bit lacking, but it is good to see the Russell 2000, which is a small cap and mid cap cohort of companies, close at new all-time highs here today. So something to watch for signs of something different. On the external, on the international markets, the developed world ex-US ETF, the month of October so far has been indecisive, but we are above the highs from the month of September. And really, across the board in international markets, the strength has been maintained. Not so much weakness on Friday, like the US market did. That's the Eurozone. That's the Japanese stock market. And you can see it's small to see, but these bars are monthly bars because this pink area is 33 years of a bear market. Once again in October, Japanese stock market is up and stronger than most of the world. In other areas in Asia, Korea continues to be quite strong. You can see in blue the relative strength line versus the S&P has steadily been rising. If we just take the Asia 50, which is the largest companies in Asia, largest 50 companies, again, nice rising relative strength versus the S&P. So as we've talked about, international markets continue to be quite strong. There's Shanghai down very slightly on the month. And that's after, as we talked about, some saber rattling at the end of the week last week, but down about a half of 1% on the month so far. Africa has continued to march hard. This is a region we might own for different reasons. Basic materials would make up a big part of the African index. Companies like Anglo American. You can see today closed at a new relative strength high versus the S&P, so it continues to gain. And in South America, also more for materials, Peru and some of the other countries have been quite strong. Peru up 43% since the beginning of the year. So international markets continue to kind of climb, and they continue to relatively outperform the US stock market. And that's something that we take note of. We continue to build our weightings in our global fund and in our global strategy as a diversifier, because frankly, these are a cohort of stocks that are less well owned for sure than the quite crowded large cap growth stocks in the US. Emerging markets had a weaker week. This is the PIE ETF, which is made up of some of the emerging markets leader. This was the big down day on Friday. Had a great bounce yesterday, a little weaker today, but relative strength still rising and the uptrend is intact. We'll see. It looks as though we got and closed above the 50-day moving average. And it's relevant because when you get a big surge in 6-month momentum or the upward trajectory in prices, very often you have a check step, but then you carry on higher. So we had this here, maybe we're getting a little check step here. But my guess is 6 months from now, we're going to be higher in emerging markets as well. TSX hasn't missed a beat. It's up almost 2% in the month of October. Certainly better in US markets and in line with international markets. Makes sense. Sector weights are similar in the TSX versus the MSCI All World Index. And no change here. All World Index relative to the equal weight S&P. Above recent highs, and the TSX continuing to gain relative ground versus US stock market. So there is money in motion. Flows are favoring international markets. We probably aren't alone in having reduced some US exposure a little, although we're probably a little ahead of the curve. Global valuations, an update on a chart we've been showing over recent months. It's interesting to see the price earnings multiple for emerging markets and developed markets has actually come down recently, not because prices are moving lower, but their earnings are growing faster. So we're getting a pickup in earnings growth in both developed market around the world and emerging markets. PE sort of in and around the same level they've been at the US. So this valuation differential, I think, is sort of enticing considering that price supports the view. So global equity is still quite attractive. On fixed income, uh, we've talked a little bit about the fact that you tend to get a second surge after a first surge in inflation. Um, Over the most recent data point, 72% of CPI components are rising faster than the Fed's 2% target. Now we're on a little hiatus on CPI data because the US government's closed, but certainly something worth watching. And 30-year yields continue to be pretty sticky, meaning that the long end of the US bond market continues to sort of drift lower, and I think is a bit problematic for bond investors. So what do you do if you're an income investor? In a world where long-term rates are sticky and going higher, we think dividend growth is the place to be, and focus on inflation protection assets. And that brings on commodities. When rates bottomed in 2020, commodity prices started to lift, and they are still lifting. Now, some better than others. If you look at the long-term picture, this was an important inflection point in 2020. And this would be typical, a first leg higher, a tightening cycle, and then a second leg higher. Gold continues to work its way higher. This is, again, monthly bars. So you can see month of October actually is on pace for the best month we've seen since this bull market began. September had an excellent month as well. We're now about 80% above the rising 200-week moving average. Now, in the 2000s, once gold got to 80% above the 200-week moving average, there was a correction of a period of months. And that's a possibility, you know. Having said that, there's a lot of signs that this bull market may be more like the 1970s, where the first leg higher got to 170% above the moving average, which would be a long way from here. Part of it is that private investors just aren't engaged in this bull market in general. Part of it is that there have been relatively few flows into the gold ETFs. And it's still relatively early on from a time perspective. When we look at it, a lot of the gold being purchased is being bought by central banks. And we can see here over the last few years, big pickup in central bank purchasing. When we look at silver, and this is another reason why we think we may be relatively early in this bull market, silver's had a great run since the beginning of 2024. But here at the far right, you can see we've just closed, or we are this week above the high from the previous rally. And let's look at that. This is silver going all the way back to the 1970s. Peaked out in 1980 at this level, peaked out in 2010. And we've just exceeded both of those highs. So if we're looking at a stock chart and you've had this big long base and you are just breaking out, it's unlikely that this rally is over. It's more likely that we have a measurement actually considerably higher. So with silver at just about $52, the outlook looks pretty darn good. So we'll see. Time will tell. We just can take this one day at a time. But clearly, this chart that we put up now for several months continues to play out. Gold relative to the Nasdaq 100 turned higher in the early 2000s, and then gold outperformed for a decade. And in 2024, we started to see this shift, and gold continues to outperform. So again, we're watching this in relation to what's been happening within the Nasdaq 100, which is arguably by far the most crowded investment neighborhood for people to have been focused on. And there's some change taking place. If we compare silver to the S&P 500, similar to the turn higher for silver after the end of the 90s, we're seeing the same thing again. Now, when silver started to outperform, it outperformed for a long time. Outside of the precious metals, there's the semi-precious metals like platinum and palladium. They're breaking out of multi-year bear markets. Copper is breaking out of a multi-year bear market. So commodities as a whole are quite attractive. The one area that continues to kind of confound people, WTI, West Texas oil, is trading below the range. Some obvious weakness on this peace deal in the Middle East. Having said that, we'll get to the stocks, and the stocks are not behaving the same way as oil. And I tend to like to focus on what's going on in the stocks more so than what's happening in the commodity. So we'll get to that. So, as for some time, commodities are outperforming bonds. That's the market telling us that inflation is the greater risk than disinflation. And commodities relative to equal weight S&P, continue to outperform. So commodities have a place in the portfolio, and we often over time have used fixed income as the way to hedge risk. And I would say today the market's telling us that to hedge the current risk, which is more like inflation, commodities are an asset worth watching now. We don't have to be everywhere. We got to pick our spots. We use our top-down modeling to look at all the investment universes we can focus in and identify those that are seeing net new inflows. So from a high level, equities as an asset class, and in particular, international equities, commodities are seeing strong and improving breadth. And then there's a bunch of specific sectors that are behaving well, like financials and industrials. And these would be the areas we've been focusing our attention on. Ideally, our job is to identify parts of the market where over time more and more securities are participating or performing well. That's money getting put to work. And there's just no bear markets that ever took place in a universe of securities where the percent of securities performing well was expanding. That's money getting put to work. There's no rocket science there. We track breadth across 300 universes of securities, and we only focus on adding new positions in those areas where we're seeing expanding breadth. Now, of course, then we have to identify specific securities to use to express our view. And from a bottom-up perspective, we're looking for securities that are fundamentally sound to begin with. In other words, they meet the quality criteria, which is a factor that has been useful over time. And then we want to find securities that have price behavior that would support that quality view. In other words, are things behaving constructively? Where we can find securities that are good getting better, where the fundamental characteristics are strong to begin with, but where we can see positive change in the numbers and prices that would support our view, well, that's where our portfolio should live. The intersection between strong securities and parts of the market that are seeing net inflows. And I can't stress enough how important it is to be disciplined around this, because the world changes and we have to recognize change. When we see deterioration in breadth, it may be that fundamentally we all believe that that universe of securities has a great future, but this is the market telling us something different. It tells us to be more cautious. It tells us that while leading securities may continue to do well, the weaklings have started to peel away. And so we spend as much time trying to identify parts of the market that are seeing deterioration of breadth to say, where should we raise some cash? Where do we need to tighten our stop losses to reduce our tolerance for risk? And we stop putting any new positions on those areas. Okay. So looking through that model, if we look at from a high level in Canada, in the US, and globally, the percent of stocks in uptrends has been improving. Last week in the US, 3 of the 4 short-term indicators, percent of stocks trading above the 50-day moving average, percent of stocks with positive weekly price momentum, percent of stocks making new highs versus new lows, and percent of stocks above the 150-day moving average. 3 of the 4 were red. This week, 4 of the 4 are red. So it's something that we have to watch. Now, when I plot the bullish percent or the percent of stocks in the NYC that are uptrends, you can see that back in April, only 18% of stocks after that correction had maintained their upward trajectory. And the percent of stocks in uptrends slowly has expanded since then. pulled back a little in August and rallied a little bit back in September. But it looks as though, as of the close today, the percent of stocks in uptrends in the NYC will have reversed back down into a column of zeros, which means that sort of the defense comes back on the field. It doesn't mean everything has to sell off. It just does mean that breadth is narrowing, and we got to watch it. Now, there are parts of the market where breadth is great, and there's parts where it's not so good. Some sectors strong, some sectors weak. You can see, I mean, only 50% of stocks in the NYSE are in uptrends, which means 1 in 2. When we look at the Nasdaq 100, it's a little different story. In May, 84% or 84 out of the 100 companies in the Nasdaq 100 were in clearly defined upward price trends. As of this morning, that was 46%. And as of the close today, probably 42 or 41. I'll have to do the calculations tonight. But again, that's a market's narrowing. It means 41 of the 100 are behaving okay, and 60 are not. So it shouldn't be a surprise that over the last couple of weeks, we have reduced further our exposure to large cap growth stocks. It's not that they aren't great companies. The question is this where new money is getting put to work, or is money moving? At the end of the day, our job is to identify market leadership. What is it that's attracting capital? What is it that is getting positively revalued? Our job is to watch for change. And part of it is tracking this breadth data. When breadth starts to narrow, we have to recognize it because it may be the index still looks great, but the composition of that index is starting to weaken. In the absence of leadership, we got to be prepared to play some defense. So let's look at sector leadership for a minute. Financials have been leadership since 2021. This is the ETF XLF, which is broad-based financials ETF, continues to kind of march along month by month. JP Morgan reported its earnings yesterday and beat the estimates. Across a broad set of metrics, their numbers came in at or ahead of expectation. And Jamie Dimon's commentary was relatively upbeat, probably more upbeat than it has been in the last few quarters. Relative strength for JP Morgan shares has continued to be strong. So we're trading above all the moving averages. It's a long position. Eurozone financials have continued to mark higher. These are monthly bars, down very slightly, about 0.6% in the month of October so far. And Canadian banks, this is the equally weighted bank index in Canada, ZEB, which is an ETF, again, continuing to march higher. So financials continue to be strong. Not exciting, but continue to be strong. And that's why it's our largest weight. Great dividend growth, strong improving earnings, a good inflation hedge, because when rates are low in the short end and long-term rates are higher, financial services companies make more money. Industrials. Industrials have led since rates bottomed in 2020, and they continue to be strong. Aerospace and defense has been leadership in the market, and we're basically at relative strength new highs. Companies like Howmet Aerospace, which we've talked about, and GE Aerospace, benefiting from the spending that's coming from the defense sector. GE Vernova, the maker of gas turbines used in gas peaker plants and nuclear power plants, is sold out over the next several years of their turbines. So it makes sense. Shares continue to be very strong. But last week and the week before, we talked about the fact we've added to our positions in industrials in both Caterpillar, which had just a dynamite day today, up 5%, and Finning Equipment, up today 3.5%, both making new absolute and relative strength highs. So these are companies that effectively sell picks and shovels. In the mining industry, which has been performing very, very nicely and commodity prices are rising, there's obviously money to spend. Companies are able to raise money in the market to do additional development work and start new projects. And both Finning and Caterpillar should benefit from that over a long period of time. But there's parts of the industrial sector not performing so well. Transports continue to be problematic. The relative strength has continued to weaken. This is a group that we've continued to kind of stay away from. This is the rails and the truckers. It also includes Uber. So aerospace anywhere is performing well. This is Embraer, the heavy equipment companies performing well. And then we talked a little bit about automation and robotics. And Kraken is a small cap company, about $2 billion market cap, which we talked about last week, makes intelligent surveillance equipment for underseas defense. So moving on, the gold miners continue to perform really, really well. It's just getting repetitive. They've just been marching higher. Sector's now up just about 80% since it made new highs in March of this year. Kinross today was pushing on new highs and made new relative strength high, and Agnico made both relative strength and absolute new highs and showed very little weakness on Friday with the market down hard. So the golds are doing exactly what you would expect. And when the question is, are they getting crowded? Yes, there's a little bit more buying taking place in the ETF on a daily basis. This is not a bubble or crowded in any way. In fact, over the course of the year, there's been a lot more sold by retail investors than purchased. So as the price of the units have been going up, actually the number of units outstanding is going down. To me, it looks like there's a long way to go. Still only 1% of global equities. So last week we talked about adding Major Drilling, which is a drilling company supplying drilling services to the development companies in the mining industry. It continues to look really good, still very early stage. The uranium producers have had a great week, probably again the best month that they've seen since the group started to lift off earlier this year. Cameco today was up almost 10%. So leaders continue to lead, but still probably early days. Copper producers continuing to perform well, again, probably early days. And so companies like Hudbay, we think, have lots of room to run. And I wanted to highlight today, there was discussion obviously on Friday about rare earth and rare minerals. Some fear that China was trying to put a chokehold on the US on rare earths. The REMX is an ETF that owns companies in the rare earth area. And this is a holding in our macro portfolio, which really had quite a dynamite couple of weeks. So materials continue to march along. Energy has been consolidating. Imperial Oil pulled back a little bit over the last 2 weeks, continues to be higher highs and higher lows. Tamarack Valley, higher highs and higher lows. Headwaters, higher highs and higher lows. We're getting into the seasonal time of year where these should perform well. So other groups, large cap tech in general is a little bit weaker. This is the communications sector. This is the last 2 weeks. We're just moving back, sort of the 50-day moving average. Nothing to be concerned about. Relative strength is basically sideways. We've reduced our exposure a little here by way of Netflix and Meta. Tech is consolidating a little bit. Semiconductors also pulling back a little bit over the last 2 weeks. So a little bit less exposure there. On the defensives, consumer staples continue to be weak. Pipelines in general continue to be weak, although Enbridge, one of our key positions, is performing well. And the consumer is one area that really we continue to avoid. That's consumer discretionary, very close to relative strength new lows for the year. Home builders, relative strength lows for the year. And in the housing area, anything related, the mortgage REITs have been weak. The real estate investment trusts have been weak. And so from an income perspective, we continue to prefer the dividend growers versus the high dividend payers. Rising stream of income offsets the rising cost of living. Excuse me. Thanksgiving cold. So let's just talk about sector leadership. A week ago, on October the 6th, this is what the distribution curve looked like for our 41 sectors we track. The average sector had 51% of companies in uptrends. This week, it's a little bit weaker, 47.9. So the average sector lost 4% of companies, uptrends. And the composition's changing a little bit. On the far left side, sectors with the smallest percent of stocks in uptrends. A lot of stuff here around the consumer, restaurants, housing, travel and leisure, consumer staples, autos, retailers, apparel. So consumer is weak. Healthcare, right? Drugs, biotech. At the far right, we see metals and mining, regional banks, precious metals, banks, aerospace, steel, insurance. These are inflation-oriented assets. So this has been the picture for a while now. We're in a bifurcated market. Even if you just think about the NYSE, 50% of stocks are in uptrends, 50% are in downtrends. We think that we're in the kind of market where if we rifle shot, target the sectors that are showing expanding breadth, and stay away from those that are lagging, excuse me, we can make a difference. So what does it mean in the portfolios? Well, financials continue to be an important weight, just over 20%, slightly down over the course of the month, but still a significant overweight versus the S&P. On industrials, our weight is a little higher. As you know, we added some Caterpillar and some Finning, so it's about 18%. So twice the weight of the S&P. Materials would be our biggest overweight. And I had someone say to me a year ago, why would you buy any materials? It's only 1% of the index. Nobody cares. Well, precisely. This can become a much bigger sector. And in fact, there have been times in the past it was 15% of the S&P. So imagine what that would have to happen to the share prices of the companies within this group for that to take place. I'd prefer to be there while it's growing in importance. Our energy weight is still a significant overweight at 11%. Tech continues to come down as a percent of our portfolio, frankly, just because there are diversification options that allow us to be focused in stocks that are less crowded and probably give us better risk reward. Communications are now a significant underweight at 6%. And when we get down into the more defensive sectors, healthcare, only 1%, consumer discretionary, 1%, real estate, almost non-existent, and consumer staples, non-existent. So this is a market where by not looking like the index, it's making a difference. In a time when there are so many who are focused on saying, I'll just buy the ETF for the index and I'll be fine, increasingly, it may be missing the mark. Things that we're watching from a risk perspective. Probably the bigger risk in the market is what's happening in private credit and high yield bonds. Spreads have been very, very low. We've been watching how the shares of private credit related asset managers have been particularly weak, and we may spend a little more time on this next week. They have been considerably underperforming, and we know a lot of money has rushed in to the alternative asset class, private credit, lending to private companies. We're not sure investors are getting compensated well for taking that risk, and liquidity just isn't there. So when we see a little uptick in the credit spreads, just something worth watching. From a volatility perspective, volatility was up a little bit over the week. We're getting to the upper end of the range that we tend to see during quite constructive equity periods. So we're watching that. And we're watching Brent. So here we are. We're in the month of October. We have November, December in front of us. They tend to have some tailwinds. And we hope that that's the case. But we're going to continue to watch this Brent data and continue to manage our exposures. It's easy to think about taking gains in the golds, although we think it's early days. It's the same for the metals. Financial services just continue to kind of be a core holding, and dividend growth in the portfolios has been really the core of what we're trying to get done, own things with a rising stream of dividends. Things get more difficult, we'll get more defensive. We get a little bit of cash in portfolios now, not a lot. and we're very happy with the way the positions are performing. So with that, I'm going to stop and see if we've got any questions. Let's take a look. Sebastian asking any thoughts on Cameco or Next Gen Energy? Yeah, look, Cameco is a significant position for us. It's the granddaddy of the uranium producers. Of course, they also have exposure to nuclear power plant equipment at this point. Next Gen is earlier stage, much earlier stage, although a great deposit and very likely to get fully permitted. So that looks interesting. And the uranium and nuclear power space continues to perform really, really well. So Jerry says, you mentioned you start by focusing only on quality securities. How do you determine quality? Well, that's a great question. So we have a combination of about 20 factors, financial characteristics that have tended to be present in some of the most important leading stocks over the last 20 years. And they include some balance sheet tests. How strong is the balance sheet? I've said over the last many updates, we've been focusing on companies that don't carry debt. We think that companies that have a lot of debt or have used debt financing may have a harder time if long-term interest rates stay high. So I think that's a factor that you want to be considering. On the income statement side, it's great to see companies that are growing their earnings, but we like to see companies that are seeing acceleration in their earnings and cash flow. If you can find a company that has their earnings up 8% one quarter, 12% the next, 16% the next, something's accelerating, something's changing. It could be their pricing power in the case of like a commodity company. It could be the demand for their product in a growth stock. But an acceleration in the income statement metrics can mean investors might be willing to not only pay for that growing earnings stream, but pay a higher multiple of earnings. So if you get a higher multiple on a growing earning stream, you can get a geometric lift in share price. So look, there are a number of factors that have been proven to work over time. Quality is one of them. High quality companies tend to have an easier time raising capital. They have an easier time growing the business, easier time hiring the best employees. Momentum or relative strength is something that has tended to persist. And that's why we spend so much time looking at how companies are performing relative to their peers and relative to the market. We like to see relative outperformance. And value is a metric that tends to add extra return over time, find things at the right price. In most of our strategy, we're more focused on relative strength, but in our global strategy, we have 40 securities that come from the high quality bucket that are strong relative performers. That's half the portfolio. And then we have 40 securities from the quality bucket that have value characteristics. So half value, half relative strength. And then we don't carry the ballast that's in the middle of the index. What are our thoughts on copper? Do we own Foran or Capstone? Robert, we own Foran, we own Capstone, we own Hudbay, we own Southern Copper. We're quite bullish on copper and materials in general. And then I've got an anonymous attendee asking me for our opinion on Nutrien. And Nutrien has been a little tricky, as have some of the fertilizer stocks. It's a group that we did have a position in Nutrien earlier in the year. We got stopped out. It's sort of continuing to develop. We'll see. The long-term moving averages are moving higher. If I may put it up on the screen. So there we go. So Nutrien was in a pretty clear downtrend from 2022 through into 2025. Looked as though under rally. Very often, when a stock trades up across a downward trend line, it'll come back and retest, which of course it did. and it's developing now. Now the 50-day moving average has turned, sorry, 50-week moving average has turned higher. If you were to look at a daily chart, you can see that the 200-day has turned higher. We're trading above the 50-day. It looks okay. Just from a relative perspective, it's been relatively underperforming. So I think that maybe some more development needs to take place here. It would be unusual for commodities to rally without the fertilizer stocks. But at this point, we just think there might be some better spots to be. I think that's it. Will you be sending out private pool and balance fund weekly holdings soon? We send them out every week. And if you're not receiving them for some reason, let us know. We are trying to be very transparent. We send out all of our holdings weekly in each of our funds and pools. And happy to take calls on questions if somebody has a question on any of them. All right. Thank you so much for tuning in. Hopefully it's useful. And we'll see what happens this week. We'll look forward to talking to you again next Tuesday. Have a great week, folks.